You know, you've probably spent years, maybe even decades, mastering your clinical skills. You know exactly how to treat the patient sitting right there in your chair. But what about the business side of your practice? Well, welcome to this explainer. Today, we're going to completely demystify the complex financial aspects of running a highly profitable medical or dental practice. We're going to break down exactly how to optimize your operations so your financial health is just as robust and just as reliable as the incredible care you provide to your patients.
To get us there, we're covering 5 key areas today. 1. The business of healthcare. 2. Patient-first revenue cycles. 3. Equipment, lease or buy. 4. Navigating tax and depreciation. And 5. New GST/HST rules. We're really focusing on the 2 main pillars here, maximizing that incoming cash flow and optimizing those outgoing expenses.
All right, let's jump right into Section 1, the business of healthcare. So we often just assume that being an incredible doctor or dentist automatically translates to financial success. I mean, it seems completely logical, right? If you provide top-tier, compassionate care, the patients are obviously going to come, the bills will magically get paid, and the practice will just naturally thrive. But is that actually the case? Well, the hard-earned experiences of veteran practitioners tell a very, very different story.
Ontario dentist Dr. Gary Stensler hit the nail on the head when he realized that clinical excellence absolutely must be paired with sharp business acumen. He noted that so many healthcare professionals just kind of assume clinical mastery will keep them on top, but the undeniable reality, the financial decisions you make day in and day out literally make or break your practice's longevity. Remember, you're not just a clinician, you are a business owner. Okay, moving on to Section 2, Patient-First Revenue Cycles. Now look at this number, 50%. Hospitals and practices that provide a superior patient billing experience record an astounding 50% higher margin than those that don't. Let that sink in for a second. The patient experience does not end when they walk out of your clinic doors. It extends all the way through the payment process. If a patient feels like just another account number when they get a bill, they're way less likely to pay promptly. And honestly, they might not come back at all.
And the reason for this massive shift is actually pretty simple. Patients are paying way more out of pocket these days. They're now covering 30% of healthcare revenue directly. To put that into perspective, that's up from just 10% a decade ago. Because they're paying a much larger share, they're acting like standard consumers. 85% of them want electronic payment options. And here is the real kicker. A shocking 56% would actually consider switching providers entirely just to get a better, easier payment experience.
So, a patient-first approach to billing, it's not just a nice-to-have anymore, it directly impacts your bottom line. Step 1 to capture that revenue is having an online portal where patients can see a clear, plain English breakdown of their charges. No confusing medical jargon, please. Step 2, meet them where they already are, text and email. Let's face it, nobody is writing paper checks anymore. And Step 3, offer flexible installment plans. That way, those larger treatments don't turn into bad debt for you or a financial panic attack for them. Make it easy and they will pay you.
Let's shift gears to Section 3, Equipment, lease or buy. This is all about protecting your outgoing capital. I absolutely love this house versus car analogy from Montreal plastic surgery clinic partner Lucy Carvalho. Think of a high-end dental chair or your built-in cabinetry like a house. You buy it for long-term stability, because it's going to last you well over a decade. But fast-changing tech, things like an intraoral scanner or your back-office computers, that's a lot like a car. You want to lease it because it's inevitably going to become outdated in just a few years, and you'll want the flexibility to upgrade.
So when you actually weigh the two, the differences are huge. An equipment loan gives you immediate ownership, meaning you can claim full capital cost allowance depreciation from day one, plus write off the interest. On the flip side, a lease gives you incredible flexibility. It preserves your cash flow since you don't drop a massive down payment, and it offers 100% deductible monthly payments as a straight business expense. Basically, if you're upgrading in 3 to 5 years, lease it. If it's a 10-plus year cornerstone asset, buying with a loan is usually the smarter play.
All right, Section 4. Navigating tax and depreciation. Check out this breakdown because it shows the immense power of the Accelerated Investment Incentive, or AII. Normally, for a $100,000 equipment purchase, the standard rules severely limit your first-year claim to about $10,000. But the AII temporarily suspended those limits and tripled the first-year deduction. That gives you roughly $30,000 to write off against your taxable income right away. That's a game changer. But, and this is crucial, the AII is gradually phasing out, so timing your purchases before these incentives disappear is absolutely critical.
Now hold on, because there is a massive trap here that catches a lot of smart professionals completely off guard. Simply paying for equipment in December is not enough to get that deduction. The CRA has a strict available for use rule. The equipment literally has to be installed, operational, and ready to generate income before your fiscal year ends. If you buy a brand new scanner in December but it's not calibrated and ready for a patient until February, you completely lose that massive first-year deduction for the current year. Seriously, don't let a shipping delay ruin your tax strategy.
Finally, Section 5, New GST/HST Rules.
Okay, this is a major regulatory shift. For decades, literally since 1991, dentists had this very convenient arrangement where they could just estimate that up to 35% of their total orthodontic fees were for commercial appliances, making it super simple to claim input tax credits. Well, with GST/HST Notice 339, that era is officially over. As of January 1st, 2025, that flat 35% arrangement is totally revoked.
So what does this actually mean for you? You're now forced to meticulously separate your exempt clinical services from your commercial activities. If an expense is used 90% or more for exempt services, you get 0 ITCs. If it's 90% or more for zero-rated commercial appliance sales, you get full ITCs. And capital equipment? That needs more than 50% commercial use to claim full credits. The bottom line is your bookkeeping has to be absolutely flawless from here on out, or you risk some severe tax penalties.
We have covered a lot of ground today, from revolutionizing how your patients pay, to strategically financing your equipment, to navigating these tricky new tax landscapes. So I want to leave you with this one thought. Is your practice's financial health truly matching your clinical excellence? Take a really hard look at your revenue cycles, your equipment financing, and your tax structures. Because being an amazing clinician, that's really only half the job. Mastering the business of healthcare is what's going to ensure your practice thrives for decades to come. Thanks so much for joining me on this explainer, and I'll catch you next time.